Okay, this is the balance sheet budget, and we're going to be working on pulling together all of the elements for 2020 that came from the budget you built. So the first thing to do is grab the cash, and that's a nice easy pull. You just go to your cash budget, and that's that ending dollar amount right there. And then accounts receivable, if you remember, is 20% of the wholesale. So 20% of the roasting sales is the wholesale sales, which are in accounts receivable. And remember, we said we want to plan for about 30 days of balance left there, which is a little more aggressive than what the customers have actually been doing. They're actually a little bit slow in making the payments, but we'd like to forecast for an improvement there. So we go back to that sales and cost of goods sold all the way up. So roasting, there it is, 20% is wholesalers. So we're going to take that times 1/12, because that's what we'd like to forecast. Notice that's a little more aggressive than what we had before. So we'd like to turn that over a little bit faster than we have. Okay, supplies, I asked you to just maintain consistency from year to year, trying to reduce the number of moving pieces here. All right, this will come from our sales and cost of goods sold budget, and it's what we had for desired ending inventory for both the roasting business and the cafe. So let's go get that. If you go over here, here's the amount that we purchased right here, required purchase of beans, right? So we're going to look at that desired ending inventory that we want that's included in those purchases. So we figured that based on a 90-day supply that we'd like to have. Notice that we're getting a little bit more aggressive than we were to try to trim up the amount that we have invested in inventory. So we're trying to make some progress on that. And we're trying to make some progress on this one. So let's go get that desired ending inventory under cafe right there, right? That's the desired ending inventory that we'd like to have on hand for the cafe. And this, I asked you to just maintain consistency. We're good there. All right, and these I asked you to maintain consistency. We didn't make any additional purchases of property, plant, equipment, so same dollar amounts. All right, now let's go get our updated accumulated depreciation for 2020. Put it equals and a minus, and then you got to go to the depreciation schedule and get that grand total right there. Okay, so that's the amount for 2020 accumulated depreciation. So since these assets have been put in service, that's the total amount that we've depreciated since that time. So this is the asset cost, this is the accumulated. All right, the investment is off the investment schedule. That's the grand total that we have at the end for investments. And that's exactly right. Okay, here we go. We're going to get our accounts payable. So we're going to look at our purchases of raw beans. This is the only outside purchase that we have in accounts payable. And we're going to plan for having 1 month or 1/12 of that amount of purchases on hand. So we're going to average that out. So let's go get that. Our purchases of the raw beans is the only one we have that's outside right there. And we're going to multiply that times 1/12. Again, use your parentheses. Yep, that's right. Okay, wages payable. If you remember, there were 2 direct labor pieces, one for roasting, one for the bakery, as well as the SG&A payroll expenses. So you got 3 things you got to add together. And then if you remember from our conversation in the last budget for cash disbursements, we have 1 payroll outstanding at the end of the year that we haven't paid yet. So when we did the cash disbursements, we did 23 out of 24 payrolls, and we're going to pick up the last one here and accrue it. So let's get those. First one's right there. That's a total labor cost for roasting manufacturing. This is total labor cost right here for just the bakeries baking, right? So those are directly related to the manufacturing process. They go to cost of goods sold. Okay, they go to cost of goods sold. The other wages are in SG&A budget, and they're right here, right? So you got 3 pieces, that's good. Multiply that by 1 divided by 24. So you want 1/24 of that is still outstanding. All right, that's pretty much in line with what we had before. Okay, taxes payable. Careful here when you put an equal sign in, put a minus, because when you go to get that, you're going to base it on what you have here for taxes for the year. And at any given point in time, we have about 25% of that outstanding. So multiply that times 0.25. Okay, this I asked you to hold constant, so just grab that. And then this, you got to get that interest that you haven't paid yet, but you did accrue when you did the income statement. So the interest payable that's due is right there. That's in the interest column. That payment hasn't been made yet, so you can't show that it's not paid. So you expense the whole thing. Let me show you again. Right back here, you expensed 100% of that interest, right? 11,093. But this part of it, right? So this part right here, you haven't paid yet. It's still due. So that's why that shows up on the balance sheet as an amount due. And then you have to pick up also what you have left to pay on the principal. So this is what you have left to pay at the principal, because you paid this 11th payment, but you haven't paid this 12th payment yet. So that's the amount right there that's still outstanding. Okay, these just come from your budgeted shareholders' equity. That's common stock, ending amount. And then this is the retained earnings ending amount. Good to go. All right, we have a beautiful balance sheet. I'm going to stop this video and we'll start another one for the statement of cash flows.